This is Macro Horizons, episode 332, Midsummer, Mid-Range, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of July 14th. The first week of the Extel Global Fixed Income Survey is now behind us. There are only 3 more weeks to go. We're hoping for support and 5 stars in the categories of U.S. rate strategy, technical analysis, fixed income, and short duration. We truly appreciate your help and feedback. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, the Treasury market received a great deal of information, certainly as it pertains to some of the potentially bond-bearish influences. Most notably, Congress passed a budget and the President signed it. This will increase deficit spending and also solve the debt ceiling problem, at least for the time being. As a result, we're anticipating that bill issuance will increase rather dramatically in the coming weeks, and while the budget process was viewed by many as a potentially bond-bearish event, the reality is that Besant has no appetite to increase auction sizes for the foreseeable future, at least not outside of the bill market. As a result, there wasn't the widely anticipated backup in longer-dated yields. In fact, it proved to be a classic sell the rumor, buy the fact event in the Treasury market. Investors also learned President Trump's approach to the end of the 90-day extension on reciprocal tariffs, i.e., he extended them for another 3 weeks. Now, this was accomplished somewhat indirectly by issuing letters to the U.S.'s major trading partners outlining the new tariff schedule and noting that the new tariffs take effect on August 1st. The president has said he will not extend reciprocal tariffs again, although a lot can change over the course of the next 3 weeks, certainly in the White House. If nothing else, this has offered a reprieve for the potentially bond-bearish influences of the trade war as it pertains to driving further goods inflation. Investors also saw the FOMC minutes from the June meeting. Here we learn that the committee is somewhat split, with a couple members being open to a July rate cut, whereas some members didn't want to cut at all this year. Our biggest takeaway from the recent Fed messaging is that the next rate cut will be data dependent. That's not necessarily new, but perhaps more importantly, the committee doesn't need to see a material downshift in the real economy or a spike in the unemployment rate to justify cutting rates. It simply needs to have confirmation that realized inflation is trending lower and that forward inflation expectations remain reasonably well contained. That leaves a September rate cut on the table. After all, by the September 17th meeting, the committee and the market will have the benefit of CPI prints for June, July, and August. 3 months' worth of inflation updates should be enough for the Fed to be confident in its September decision, one way or the other.
After the payrolls report, a long holiday weekend in the U.S., and frankly, a data calendar with not a ton on it, aside from Treasury supply and the FOMC minutes, this week was probably always going to be one that was best defined as a summer trading environment where yields did little other than put in a reasonable period of bearish consolidation as 10-year yields continue to hold within striking distance of what we're characterizing as the tether of this current July trading range, which is the 200-day moving average, let's say right around 435, and the market awaits greater clarity on the path of inflation, the trajectory of the labor market, and the Fed's thinking as it relates to the timing of the next rate cut. It would be inappropriate to characterize the jobs report as anything other than solid, and despite the worries around the trajectory of the labor market that we've heard make the rounds among market participants, the data itself has done practically nothing other than to cement a wait-and-see stance from the FOMC, and in turn a sort of wait-and-see stance for the Treasury market as well. We'll have next week's CPI report to contend with, of course. But as we contemplate what NFP, the Fed speak, this week's Treasury auctions, the FOMC minutes have all done, it's to suppress volatility, diminish trading volumes, and bolster what is increasingly feeling like a more traditional summer trading environment.
We also heard from Trump on the trade war. Recall that July 9th was the end of the 90-day pause for reciprocal tariffs. What the administration decided to do was issue letters to many of the U.S.'s major trading partners outlining the new tariff schedule. These letters contained a forward start date of the 1st of August, so there's still at least 3 weeks for any individual nation to try and reach a bilateral agreement with the U.S. before tariffs kick in. Now, it's notable that over the last couple months, tariffs have increased. Even though there was a pause on reciprocal tariffs, levies have been higher, and it's interesting to see that that has yet to rebase CPI, or core inflation, higher. There has been an identifiable increase in certain goods prices, but on net, it hasn't led to a reinflationary trend that many had feared. Now, this isn't to suggest that come August 1st, we won't see another leg higher in realized inflation, but rather it does bring into question whether or not the trade war will, at the end of the day, spike inflation during the second half of this year. If the experience of April and May is an early indication, prices will be increasing, but perhaps not as dramatically as initially feared following Liberation Day.
And this gets at one of the topics that was addressed in the minutes of the June meeting, namely the fairly significant role that the trajectory of tariffs and the risk of higher prices resulting from them played in the discussion among monetary policymakers in ultimately delivering the statement and SEP in June. And the Fed has acknowledged that, at a minimum, the trade war and on-again, off-again tariffs, both in terms of tariffs at all and also their magnitude, has on the one hand reintroduced some reasonable upside to the inflationary outlook, and on the other has increased uncertainty to a degree that it is showing up in conversations with businesses and is starting to have a demonstrable impact on hiring plans. We saw within the minutes that hiring and layoffs have slowed, and generally speaking, business activity, unsurprising given the uncertainty, has downshifted in a way that suggests perhaps simply the next few quarters may be defined by slower growth as businesses evaluate exactly what will come to pass in terms of the global trade landscape. Now, this uncertainty, combined with the potential upside impact on prices resulting from tariffs, only entrench the operating bias at the Fed that the best thing to do at this stage is nothing, and wait and see how tariffs, or not tariffs, ultimately flow through to the real economy and the data. But with June's payrolls report serving as the most recent example, at this stage there's not a ton of concern on the current state of the labor market. Sure, some worries about what will come to pass, but with rates already 100 basis points lower than they were this cycle, and some questions about the degree of restriction that's being exerted with yields at these levels, the biggest takeaway from the minutes was that risks remain both to the inflation upside and employment downside, but we're just going to have to wait and see.
We also learned over the weekend that the budget bill passed, which was viewed by many as a potential bond bearish trigger. Ultimately, however, it didn't lead to higher rates. What drove the modest in-range sell-off was the stronger employment report. What we learned from the bill was that there was appetite to increase the debt ceiling by $5 trillion, which moves the timeline for the next debt ceiling drama out until the middle of 2026 or later. This has freed up capacity on the borrowing side for the Treasury Department, and we're anticipating a very quick run-up in bill issuance, and we're estimating that between now and the end of the year, the Treasury Department will issue somewhere between $700 and $800 billion in new bills. Now, Bessent has made it very clear that the Treasury Department has no current intentions of increasing coupon auction sizes further out the curve. Therefore, we're viewing this as the elimination of a potentially bond bearish risk. Now, it goes without saying that eventually Treasury coupon auction sizes in 10s, 20s, and 30s will increase, but we're now looking at the August 2026 refunding process as the first potential timeline for larger auction sizes.
And the question as it relates to what this means for the broader market is how this increase in bill issuance and, to your point, Ian, this not increase in longer-dated coupon auction sizes will flow through to the broader curve outside of what promises to be some upward pressure on bill rates as the increase in supply and getting the TGA back to $500 billion by the end of July gets absorbed by what we still expect will be a solid demand backdrop for the shortest dated Treasury securities. A lot will hinge on what we learn from the August refunding process in a few weeks, where we expect some greater clarity will be offered on exactly what the plan will be in terms of the weighted average maturity of the market and just how many bills Bessent is planning on issuing. But for those that came out of election night and coming into the new Trump administration, expecting that a significant fiscal push driven by ballooning Treasury issuance was going to be an inevitable bear steepening of the curve, the fact that both President Trump and the Treasury Secretary seem very focused on keeping 10 and 30-year yields low, controlling what they can from a supply perspective, runs counter to the bear steepening argument, particularly given what we continue to see in terms of sponsorship for long-end Treasury auctions.
It's also worth keeping on the radar as the August refunding announcement comes into focus, the potential for Bessent to restart the conversation about increasing liquidity buybacks. Recall that we've been viewing this as a potential stealth operation twist whereby the Treasury Department is borrowing heavily in the very front end of the market while not increasing auction sizes further out the curve and simultaneously increasing the size of the buybacks. Now, in the event that the Treasury Department chooses to go this route, we don't anticipate that this will completely redefine the shape of the yield curve. However, it will be yet another incremental hurdle on the way to a steeper yield curve, particularly as we continue to see a reasonable path for the 30-year bond to underperform over the next several months.
So, put a different way, for an extension of what has already been a fairly impressive steepening of the yield curve this year, from these levels that will probably need to be of the bullish, not bearish variety. Said differently, a move toward lower yields that is led by the 2-year sector, which will need to be a function of the economic data. And let's face it, to look at the price action over the last several months, it's become clear that the 4% level in 2s, 450 level in 10s, and 5% level in 30s all have been drawn as important lines in the sand that continue to bring out buying interest. So, to extrapolate that onto the shape of 2s, 10s, that means that if we're going to see the curve meaningfully above 50 basis points, it's probably going to be in an environment when 2-year yields are closer to 350 or 325, not 425 or 450.
So, Ben, it sounds to me like what you're saying is that we're going to be focused on the bonds of summer.
Well, Ian, when I get to podcast with you, I'm reminded. Life's a beach.
Just watching those lines in the sand. In the week ahead, the biggest data point of any relevance will be the core CPI print for the month of June. Here, the market has a consensus of 0.3% for the monthly gain, and with an unrounded guesstimate closer to 0.25 or 0.26, there is a potential for a downside surprise. Within the details of the release, the market will be looking for any clear evidence that the elevated tariffs have finally started to flow through to realized inflation. Goods inflation and autos will be the obvious touchstones in this regard. Note that the degree to which inflation will ultimately be impacted by the trade war is an open question. It's an open question for market participants, and it's an open question for the Fed as well. In this context, we'll be looking at the supercore measure of inflation, which is core services excluding OER and rent. Note that this gauge of inflation has been extremely well contained over the course of the last few months, which surely provides some solace to monetary policymakers as they contemplate the timing of the next rate cut. The week ahead also includes PPI as well as import prices for the month of June. So this means that by Thursday morning, the market will have all of the key components needed for a reasonably accurate core PCE estimate. As it currently stands, we have penciled in a 0.2 core PCE figure for the month of June. Now, obviously, the data in the week ahead could either refine that higher or lower, depending on how inflation comes in. We'll also see the June retail sales figures. Expectations are for a 0.2% gain in the month of June, which, in light of the recent headwinds for personal consumption, a 0.2 retail sales number, which is in nominal terms, wouldn't be particularly encouraging for consumption during the second quarter. Now, as it currently stands, Real GDP is tracking above 2.5%, so any market participant expecting another quarterly drop in real GDP will most likely be disappointed. That doesn't mean that the pace of personal consumption won't be relevant. Recall that despite a strong initial print for personal consumption in Q1, it was ultimately revised lower to somewhat more troubling levels, albeit still in positive territory. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. With the pause in reciprocal tariffs extended for 3 weeks, it hasn't gone unnoticed by us that tariffs now kick in on August 1st, the final date to vote in this year's Extel Global Fixed Income Survey. A complete coincidence, to be sure, although one that allows a little more time to get out and vote. Just a thought. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.